Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This particular video is going to be associated with the article where I was talking about how prudent dividend growth investors can design an appropriate dividend growth portfolio for their retirement. And what I'm really trying to get across here is there's a lot of different types of equities, dividend-paying equities that investors can choose from. So my first example here, I'm starting out with one of the highest quality real estate investment trusts in the country, Simon Property Group. And I want to look at it from a standpoint of what its usefulness is as far as putting it into a retirement portfolio. First of all, I want you to notice that the FFO calculation here, this orange line represents the intrinsic value based on FFO. You can see the company was reasonably overvalued. It's now come into fair value territory and actually become undervalued, which means it's a great time to buy it. As a result, the current dividend yield is over 5%, which is very attractive in today's interest rate environment, as I covered in the article. So this would be a great time to buy it. But the real advantage here, if I look at the long-term historical performance, I want you to note that the dividend growth rate has averaged about 8% a year. If I look at that from a standpoint of the company's historical FFO growth at about 7%, that's consistent considering that the REIT was really undervalued at the beginning of this time frame. I just like to point that out. But what I really want you to see here is the income advantage. This company historically has generated significantly more income than the S&P 500, but it's also outproduced it on a capital appreciation basis long term. So this is a tremendous income producer, but simultaneously it's also capable of generating some good capital appreciation. Let's look at it just since the Great Recession. The reason I want to show you this time frame is because this is one of the most powerful time frames for the S&P 500 in modern history. So let's look at performance starting at the beginning of 2009. If you'd invested $10,000 in Simon Property Group on December 31st, 2008, your total dividend income through yesterday's close would have been $10,684 versus $3,700 in the S&P. So, this is one primary reason to include higher yielding REITs in your portfolio. The income advantage here is almost triple what the market did. But now what's really interesting about this particular example, even though this was such a profoundly powerful time, the market did about twice its normal long-term historical average of 6% since coming out of the recession because it came out of a low earnings base. But this REIT literally mirrored it. It did almost exactly, just a tad, a few dollars less than in terms of growth or capital appreciation than the S&P 500. But the total rate of return, thanks to the great dividend advantage, was significantly higher. So what we're looking at here is a undervalued REIT that's really attractive. But I promised in the written portion I'd talk about valuation. I want to make sure people understand the importance of valuation. So I'm going to use this example to illustrate how important valuation can be. Let's assume that we bought this on March 29th, 2019 at a blended PE ratio of about 15, which is what I consider fair value. The expectations of future growth would imply that we could average a 7.4% rate of return going forward. Okay, but here now we can go with a slightly shorter time frame and buy the stock at a blended PE of 13.21, and instead of earning 7%, we get the opportunity to earn almost twice that much, or 13% a year. So this is one example, as I promised in the written portion, where valuation is critically important. Now with my next example, I'm going to look at the mortgage REIT, AGNC, and I want to talk about this because there's a lot of things that I think are important here. I'm going to go as far as I can go on this particular mortgage REIT. And I want you to see a couple of things. Statistically, if you're just looking at it as a quotation in a service or a paper, the company has a price FFO of 7.6. That's what I would call roughly half of normal fair value, or what fair value would be. It offers a dividend yield of 11.5%. The company only has 3% debt to capital, but I will point out, and I'm not going to get into the details here, this company is a mortgage REIT that utilizes leverage consistently. But from a prudent retirement portfolio, this one is sort of a conundrum. Let's start by looking at its history. I want you to see that FFO growth has been negative over this period of time. It's averaging negative 0.47% if I shorten the time frame and get rid of some of that part, it's actually a negative 11.67%. The point is the company's operating results have been shrinking. But I also want you to look at their dividend record. They paid $5.15 in 2009, raised it to $5.60, held it through 2011, then they cut it to $5, then they cut the dividend to $3.75, then they cut it to $2.61, cut it to $2.48, cut it to $2.30, cut it to $2.16 and held it there before they cut it to $2 and are expected to cut it again in 2020. So when you look at this from a performance result, it's really an interesting stock. First of all, I want you to notice it did generate powerful income. A $10,000 investment on December 31st, 2008 would have generated over $17,000 in cumulative dividend income, again versus $3,700 in the S&P. But your $10,000 investment would have actually shrunk. Your capital would have shrunk to $8,000. That's almost a 2% annualized loss. And then you add in the dividends and your what's left over, and you do get a 9% rate of return, but it does underperform the S&P 500. The question is, as a retired investor, is this the kind of performance that you can live with? Can you stand the fact that you would get these big dividend cuts on a portion of your portfolio each year? And that's one reason why I don't consider these appropriate, or this particular company, but mortgage REITs in general, appropriate for a prudent retirement portfolio. With my next example, I'm going to go look at a more traditional dividend growth stock, the Royal Bank of Canada. And here I'm looking at it on the Toronto Stock Exchange and looking at it in the Canadian or country of origin currency, because I think it's important. I want you to see the consistency that this company has generated. It's currently available at a blended P of 11.8. It's a financial company, tends to sell at a discount, which is actually quite common for financials. The normal PE ratio of this company has been just under 13, 12.7. So it's trading at a discount to that. It's attractively valued, does offer a nice 3.9% dividend yield. And we look at it historically from a performance perspective. Its average growth of their dividend has exceeded 11%, as well as its compounded average growth. It has generated significantly more income than the S&P over this time frame, which goes to September 30th, 1999 to yesterday's close. But it also really outproduced it dramatically on a capital appreciation basis. So this is a very high quality, AA- rated, consistent dividend growth stock that is currently available at attractive valuation that I think dividend growth investors can utilize if they're in retirement as an income vehicle, but also even if they're in the accumulation phase, it can also be a great total return vehicle. So it fits virtually almost any retirement portfolio you might want to look at. Now, I do want to just make a real quick point here. I'm going to look at this because this is duly listed on both the Toronto Stock Exchange and the U.S. Stock Exchange. So I'm going to take a look at this company as it trades on the New York Stock Exchange. So now I'm looking at Royal Bank of Canada in US dollars, and you've got some currency. So it looks like there's been some dividend cuts if you're buying it on the New York Stock Exchange. There actually haven't been. That's strictly the effect of currency. That's why I wanted you to see it in the Canadian version. But regardless, it's still produced in US dollars a very wonderful track record, dramatically outproducing the S&P in dividend income, even more so than we saw in Canadian dollars. Tremendous capital appreciation, and it did more than twice as well as the market over this period of time. So Royal Bank of Canada is really an excellent and attractive dividend growth stock with an above average market yield, almost twice what the market average is. It's above that 3% sweet spot I alluded to in the article, and it's certainly getting it close to 4%. With my next example here, I'm going to go to General Dynamics Corporation, because this is really an interesting stock, and I've covered this recently, but I did want to just point out some things because I'm talking about being appropriate, I'm talking about buying things for a retirement portfolio, and I talked about in the article about how time in the market is critically important. If you look at this particular company historically, if you bought it in November of 1999, it has produced a significant outperformance against the S&P in terms of total dividend income. And once again, we see significant outperformance in capital appreciation. And when we combine the two, we once again see significant outperformance against the S&P. And it's been very, very consistent. But I want you to notice this was attractively valued at that time. And it got overvalued just in 2018. But I really want to focus on something here because I want to once again go over this idea of why valuation is important. Let's say that we purchased this stock on January 31st, 2019 at a PE ratio of approximately 15. Based on the expectations for growth going forward, we could assume that this would generate a 10% rate of return for us, and that would be very attractive and very, consistent for what a retirement portfolio needs, especially considering the fact that we would be getting almost slightly over a 2.5% dividend yield. But if we bought that stock today and it's just now at a 16 PE ratio, just a few months later, our expectations now instead of 10% drop down to 8%. Now, if you're compounding money at 10% over a lifetime versus 8%, the difference in the amount of money you would accumulate and earn over that time frame is extraordinary. So valuation is important. I just thought this was a nice way to really highlight how important it truly is. With my next example here, I'm going to take a look at Comcast, and I consider this a really interesting dividend growth stock for a couple of reasons. One is it's really more of a total return vehicle than it is a current income vehicle. It has the lowest yield of what I've shown here today. It's yielding about 1.86%. I do want to look at this company from the point of view of when they started paying a dividend. The earnings growth since coming out of the recession has averaged over 17%. The company yields about just under the market, 1.86%. It's A- rated and has moderate debt. But if you look at performance since coming out of the Great Recession, its dividend growth has averaged about 20% a year. It's produced significantly more dividend income than the S&P. But look at the performance advantage. It's also, increased significantly more capital appreciation. So this is the type of dividend growth stock that investors who still have time before they retire might want to consider, because what you're focusing on here would be what I call the growth yield or the yield on cost. You can see that in 2009, you'd have received about 1.8%. I want to point out that's about what the company is yielding now. So from a standpoint of going forward and looking at dividend increases, you can see that by last year, that 1.8% yield on cost increased to over 9%. And that's exactly what I think retired investors need. They need, investments that give them an increase in pay every year. So anyway, this is Comcast. And then finally, I want to take a look at Charles Schwab and Company, because statistically, it's kind of interesting. It has a, currently available to 16 PE. Its historical normal PE, I want you to notice the market has always applied a premium valuation to this stock. The company has recently fallen dramatically. I think part of that is because growth is expected to really slow down over the next couple of years. So, you're looking at a stock that has relatively low yield. I want to look at the historical performance. This company froze their dividend from 2010 all the way through 2015. And their dividend income has actually been less than the S&P 500 over this time frame, and their capital appreciation has been less as well. Now let's analyze how that happened. That happened because the company was pretty fully valued. If you look at the long-term growth, the long-term perspective here, performance of this stock has been very dramatically underperformed the market over this time frame, but that can be primarily attributed to high valuation. So this is not the kind of company that has the consistency. It's a great company. It's A-rated, only has 25% debt. It's reasonably valued today, but if I look at it going forward with growth expectations, right or wrong, there's not a lot of growth expected over this company in the next couple of years, so I don't see a lot in capital appreciation. So the point is, look beyond statistics. Anyway, I tried to show here just how variant the types of dividend growth stocks can be when you're looking at your dividend growth, trying to build a dividend growth portfolio. There's a lot of variations in between these. I've only scratched the surface, as I pointed out. But anyway, I hope you got some benefit out of understanding how to build a dividend growth stock and how to pay attention to not just the statistical references, but analyze what you can expect a dividend growth stock to be able to generate for you over time. This has been Chuck Harnwell saying thanks for watching. If you like what you saw, don't forget to subscribe to our YouTube channel to see more videos in the future. Thanks.